Okay, so hello everyone. Hope you've had a good week. In this class, we're going to go through a few trade reviews that I got sent through. I think we're up to date with them now. If there's any missing, send them over and we'll cover them in the next one. But I did have a look. I think this will be all of the ones that are in so far. We're going to go through some trade reviews. If it's not trades that you've personally posted, there's still good lessons to take from these as well. So it's definitely worth watching. Basically insights into what's done good, what's done bad, what you could look to do in your own trades. Some of these things are likely to resonate with you because we're all trading in similar ways, even though there will be some slight differences. Then we will go and look at some current charts, and then we can do some kind of technical Q&A stuff as well, if you've got any questions or any specific charts you want me to look at right now too. So, with that said, let's get into the first of these charts to run through. So, right, let me just set this up. I'm just making sure I've got the chat and stuff to view. All right, cool. So the first trade we have is a day trade on GBP JPY. This is a trade executed from here and then a scaled in position taken from there. Overall, this setup, I would say, is pretty good. There's a couple things I would have done differently, but that's not to say that this is wrong. It's just my personal approach. So the idea of this trade, by the looks of it, was just to sell from area of supply. There's this area and this area as well. And the idea was to sell down towards this area of demand. Now, I think the setup in its most part is fine, due to the fact that the stop loss was positioned over here, and then it was prepped that a second entry could be approached if that stop was hit. Now, I would hope that this second entry would probably be with confirmation. So the only change I would make if it's not like that already would be that I wouldn't sell limit here if this sell limit had lost. The reason being, obviously, if the market keeps going up, you've taken a double loss there. So, in my opinion, it makes more sense in an instance like this. If you are going to go with this kind of aggressive approach of selling one zone and then maybe selling the second one as well, would be make sure the second one is definitely confirmation focused because otherwise, a loss here followed by a loss here, if the market just rallies up, it's going to be a -2 or -2%, not something that we like. Now, the first execution in itself is fine. It's a sell limit, it's a risk entry, so that makes sense. Here we have some equal high liquidity. So one thing I would have preferred to do with this trade, but again, this all depends on your approach to it and your level of risk tolerance and how aggressive you want to be, is if we were going to sell from here, I would have personally liked to have stops just above this level. So like up here. This, of course, would have extended the stop loss, but what we could have done to combat that, given that this market also has down here this collection of equal lows, and of course the Asia low is untouched, we could have actually sold here, stop above here, and then ran the target all the way down to here at maximum. This way, you're probably looking at, I mean, we're going to call it what, probably about a 1 to 4, 1 to 5 anyway, right? If you'd sold with that. Excuse my terrible drawings, but you understand the concept. This way, we could have, of course, held the trade on for the longer term and still got the good risk reward out of it with an understanding that these levels, especially this one here, equal lows, is likely to be hit. And it would have then actually given clearance so that if we did go ahead and sweep these highs and push into the top supply, as long as we don't break the top of that supply, we should have been good here as well. So the way the trade is taken and laid out is basically pretty aggressive, but understandable. We have sell limit, stop there with the plan to approach for a second if the trade doesn't work out. The scaling, I think, is good as well. We had, oops, a breakdown in the price, push down here, and then the pullback. That's a fine scaling, I would say. Once again, obviously, it's a bit more aggressive. Some of you might think, well, I would have wanted to take the scaling from here. It's probably more in line with how I would have approached it. But there's different risk tolerances. You know, this is going to be a bit riskier than waiting for the full pull up. But we do have that low time frame confirmation to allow that to go through. And with this being a rather aggressive position in the first place, I'd imagine this comes from a higher risk tolerance trader. So yeah, I think this is fine. Only change would be I'd have gone stop up there, and then there is room to target lower. Just don't limit yourself on targets if there is possibility for the market to continue moving. If you're expecting one of these supplies to react, then you are likely expecting the market to make new lows. Then you can look at some of the obvious factors that allow that to come through. Equal lows, that's going to be a good target rather than demand. And second to that, we've got, I mean, first of all, imbalanced demand there, but also the Asia low. So it's likely to be able to bring this trade down. Now, as much as I can see on the screen, the market did get to at least 188.1. So that would have been clear. Not sure where it went after that, but I would have been happy with the target at this level. And then even with the slightly larger stop loss, you're still looking at probably an even bigger profit than what was achieved anyway. And especially for the scaling, this could have been brought further too. So all in all, decent trade. Bit aggressive for my liking, but not that that's bad. It's different risk tolerances for different people. But my way of approaching it would be, yeah, higher stop, lower target to still get the same or better risk reward, but get that in a safer format. Cool, that's trade number one. Trade number two, this one's more of an analysis of current markets, and this is ideas for Euro USD. Now, if we compare this to my Euro USD, I think it's pretty much very similar. So I'm looking for on Euro USD, although this week, I'm not sure what the market thinks it's up to this week, but it's not really doing much. We've just been sitting in this range. I like for the kind of bigger picture idea, a push over here and then a sell lower. Or if the market wants to come lower first, a run into some of the areas of demand before we then start taking it potentially higher. It can go from daily demands, 4-hour demands. Essentially, we'd want probably a deeper pullback at that point. Also keeping in mind this potential demand if the market just wanted to take out the range before moving up. So the idea that's been put forward here is actually very similar. I think this is the one zone that we just looked at. For the sell, it's exactly the same as what I'm looking for up there. That's actually the favored scenario for me. So I'd like to see it come up first. This, I presume, is a refined demand. I actually prefer to this one, the one that sits above. So we're going to look at this area. For me, there is still some imbalance into this. The reason being, if we look at where I've got this structure marked up, we do have, let me go to a higher time frame. We do have, yes, this small break of structure, but there's a more significant break of structure from this daily and 4-hour high. And the actual zone that created that break is going to be the one that I've got marked here, right? So this zone. And then if we fail this zone, I would expect the whole range here to be filled and for us to start moving at least through towards, say, this area with possibility of extending even lower. So the only thing I would change about this markup is this demand here. Yes, it created the small break, but there is a significant break that we should be considering as well. So with that significant break having taken place from pretty much this area of demand, let me clean this up a bit. From this area of demand here, I would say this one is the more likely one to create a larger reversal. So I would personally, I mean, this is real time, so we can see how this goes. I'd personally say no to this zone. I'd say yes to this zone with confirmation, as is marked, so that's good. I would say definitely yes to this one. This is good too. And then the only other thing is I would leave doors open to potentially even lower if we got down there. But yeah, only change for this one really, aside from this zone, and I've told you my reasons why, because I'm also like this zone. I think this is good analysis and pretty much in tune exactly with what I'm looking for. So good stuff there from my perspective. Just make sure it's this one. And consider as well, the lesson from this one, I guess, would be, because everything else is perfect, just make sure that you've got the high time frame or bigger picture view in mind. This is why we like to do daily, weekly analysis on, say, a weekend. We can see this daily high broke here, which then gives more weight to this 4-hour zone, provides a bit more context for us in the terms of, intra-week opportunities as well. So that for me would be nicer than the slight push below. So yeah, the only lesson to share there, aside from good analysis, is high time frame narrative will help you to build the highest probability zones. Cool. This one then. This one was more so a question about which break of structure is valid. I'm gonna say to the person who asked this and to other people as well, because structure is something that does take a while to get in your mind. This break of structure, now that we're actually in a downtrend, so the break that took place there, that is valid. But also so is this one for a more significant move down. Now we can look at this from a swing and substructure perspective. I would even say this break here is a BOS. This is valid too. So we came up, created this high, came down, created this low. This break would be the first indication that we're going lower, and then you could look to sell pullbacks here. And then following on from, of course, selling any pullbacks there, this break of structure would validate continuations. So once it pulled back, you could look for continued selling there. And then again, now that we've broken this level, which is this break of structure, you could look for more continued selling. But what you would want to do when we start to break structure is identify where is the next significant imbalance. From this chart, I'd say this range here, essentially the demand is going to be about there. That's efficient. So then we can start looking lower. We see, well, all of this is an efficient range. So we can look at least under these lows. Then we see we have some imbalance there. We have some imbalance there. And then, of course, we have already marked the significant demand at the low, which pretty much, yeah, is going to come from the top of that small indecision candle there. So the way we could have approached this from the get-go, and to answer the question, yes, this break of structure is valid. This break of structure is valid too. And I would even say this break of structure would be valid too. So first selling there, then this BOS validates the next wave of selling. And then this break of structure validates the opportunity to take more selling. And because there is no clear demand or reversal area all the way through to here, this would look like, from this perspective, from a technical perspective, selling here would be valid all the way down into this demand. So to answer the question, both demands are valid. And I just elaborated a bit by breaking down the structure because I know that can be useful for some people. So when you're marking structure, of course, one big thing to look for when you're looking for your targets is imbalance price areas. So initially, if you'd have sold down from the high, let's say here, you might have seen this little demand retest and thought, okay, maybe this is going to reverse. But when we fail to make a new high and then we create a demand fail, the next thing to then do is look lower as to where the next likely point of reversal could be. Basically, when it comes to selling into the start of a new downtrend or selling or buying anywhere, the core thing we want to consider to make sure that we don't get kicked out of trades or stopped out of trades or try and run the market too far and end up losing all of the profits is where is the market next likely to reverse from? As we can see, because there is no imbalance down towards these points, and because there is significant imbalance and demand at this point, I'd say then after this break of structure, we basically provide opportunity to sell all the way down to this low. So a little structure lesson there. And yeah, basically looking for open areas that the market's likely to go to provide opportunity. So let's say we had a demand zone here, which was a super clear demand that the market was coming from. Then at that point, if we'd reacted with strong momentum, the only difference you'd probably make there is use confirmation instead of any form of sell limit. Realistically, I think in this instance, as of how the market is formed, sell limit would probably be fine here because we have efficient range above. There's no reason for us to go into here. And if we do, then we're probably completely wrong on the setup and it may go reclaim highs. But if we did have a demand here and the market had pushed up from there, if you went with a confirmation, you avoid that risk of, if the market just bombs straight through, you're not going to lose because you've gone confirmation focused. And then, of course, if we do get confirmation and it pushes through the demand, then you can continue trading it lower. But that's all hypothetical because in this instance, that demand isn't there. I just wanted to make sure that's all clear. It's to give you a good understanding of how you should approach kind of open demand zones in a downtrend when you're selling into the start of a new trend. Cool. This one then, we have a question about breaks of structure inside of this existing daily trend. So the way that I would view this, I think the structure marked is pretty good. We're looking at swing structure here, so it's going to be like this. We could pretty much just average it out to this move if we're looking at this large structure. So then you could see why this can be considered the valid break of structure point. And definitely it's a level to consider and be wary of. But if we then take a look at what's going on inside of this range here, although it is for the most part just a consolidation range, we do see the market went and made a low here. So then this could be considered. And then this momentum driving up to this high would tell me the likely outcome from there is going to be a continuation through. So to answer this question, it's a little bit dynamic. We have, of course, this as the more significant break. Breaking above that level could then potentially lead us through into more significant highs. But I also think it would be worth factoring this high as well because of the momentum that we've had and because of the fact that number one, we swept liquidity, but number two, we created essentially a low. So from this point onwards, if we break this high, I think that is most likely to then follow through into breaking the next high, which then would essentially follow through towards going towards the significant high. So we can definitely look in this instance at this one here. This is actually, as well, to give you another example, very similar to the AU setup. So I said on the daily, if we look at this structure, it's also a bit of a mess, but we had this break here, followed by a massive rally back to the upside, which is now pushing against these structural highs. And while we could say that this is essentially just a range high and it might be worth looking at, some of these structural points as the real breaks of structure, what we can do is definitely look at what's likely to happen if this high breaks. Now, we can say this high is likely to break because of the strong bullish momentum. And if it does break, I would then assume the most likely outcome is going to be some form of reaccumulation and follow through into the next point, which would then start to break more significant structure. So although it's kind of a range high and this area does, yes, look like a consolidation, it's essentially now had its sweep and drive to the upside, which is likely to follow through. So it's actually kind of, I guess we could view it as one of those simplified Wyckoffs that we've covered. We have our consolidation, we have our spring, we'd now look for the break, pull back buy, and the most likely way for that to form, generally because we've had such a significant strong move, would be once we break, we reaccumulate, which essentially means we probably won't pull all the way back down to the extreme. It's possible that we do, but what generally is going to happen here, given the amount of strength we've seen, is the market's more likely to reaccumulate, basically consolidate a bit and create a new range that we can then work with on a slightly lower time frame before continuing the buys up. So to answer this question, I'd say this is a valid break. If we get closures over here, we can definitely then look for reaccumulation to take us up towards the next point. Then that would create another solid break of which we could then look for pullbacks to demand to keep taking this to the upside. Cool, so that's that one. Now this one's on gold. From what I can see on this one, I like this one a lot because, as I've been saying for the past probably over a year, and to be honest, all of the money I've made from the markets this year has just been from gold. I put massive amount of my investments into gold. That's why I keep saying buy gold. Economic uncertainty, gold goes up. I mean, it's up now. I think I started telling people to buy gold at like 2,000. It's at 3,300 and something. Silver as well is another one, a big one I said to buy. That just pretty much is going to track gold. But I like this setup a lot because it is buying gold and not looking to go the other way. We're not looking to short-term sell something with such macro influence. So it is simply a trade that is following the macro structure. Now, from what I can see, we have our break of structure. This and smaller break of structure that's marked, if it is marked here, I would say this is not really the break, the valid break. If we were in any other market that wasn't gold, that wasn't so hyper bullish, the problem we have here is what this price action actually indicates. And this is a good lesson because it's important for a lot of people to understand this, is if we look at where the first low formed, it's the low of this wick. The market then pulled up to the high of this wick, but then it didn't make a new low. So the structure we're actually looking at here is like this, and you're classifying this as a break of structure, when really it's not, because we haven't created a new high just here, right? Or sorry, it's basically classifying. So let me explain this as the break of structure. The problem with this is, of course, the break of structure is actually going to be significantly higher up there. So we're basically looking at that being that point, this being this point, which let me clear that off a bit. As you can see, the high was printed, and then following that, we didn't get a new lower low. So it's basically looking at a movement like this and factoring that as a break of structure, which is not really a break of structure because it's not changing the trend, right? This is just internal noise above this low and realistically could then end in a movement down like this. So the one lesson I'd say here is if this break of structure, it's not 100% clear where it's referring to, but if it's referring to this high, this is not really a viable break because it is, of course, as we've just said, um, basically going to be, well, not like that. Factor in that as a break, which it's not yet. But we do have this break up here, higher high formed. This is a strong break as well because we have solid candle closures. Clear imbalance, clear demand zone, efficient range below. So factor in everything with this as our break of structure. This is definitely a nice buy limit buy. Stop loss is under the lows of those wicks, which is very good as well. If the market is able to break into the efficient range, i.e. get underneath this demand zone, the trade's basically doomed. But of course, in that instance, it's good to just have your stop there to get out. There's no point putting the stop this low because if we come into this efficient range, we're going to get stopped. So one big lesson with efficient ranges is if you've got a super clear efficient range there, you don't need to go all the way down here with your stop if you're getting in, say, here. Because if the market is to get into this efficient range, you're going to get stopped out most likely anyway. So you may as well just have the stop somewhere that gives you clearance on the demand that you're buying from. Put it under some nearby wicks just in case it decides to wick a little bit and then make sure that, of course, you're getting out as fast as possible. This way, you can have obviously a smaller stop loss that's still fine, which will give you a bigger risk reward. So everything about this trade, factoring this as the breaker structure, is solid. Also moving with the macro direction is very good as well. Buying gold, good move. Selling gold right now, I'm not liking the idea of that, but this one, yeah, I'm with that. Okay, cool. So this person sent me through a few that we're going to look at now. I see some pretty simple issues that can be easily fixed here. This trade, I get the basis of this trade, and I've seen a few people send trades like this as well. So this is going to be a good lesson for a few people. The idea here is, I believe, we have the Asia high, high probability for the Asia high and the low to be taken, right? We have a market that is bullish. So again, you may be looking just for a completion of that move. And if we consider market efficiency, demand zone there retested, demand zone there retested, demand zone there retested. So this whole thing from this move down can be factored into being an efficient range. So the idea is we're basically looking to buy from above the efficient range, and then you've seen the confirmation there with the breaker structure, and then this pullback could provide the opportunity to take it up to fill that high, and then of course from there maybe we get the reversal, continuation, whatever, doesn't matter. Now, the only problem I would say this trade has, which is what makes it low probability and something that I wouldn't want to take, is the reaction has actually not really come from anywhere, right? So if we were to draw on the significant demand, it's going to be really on here. So it's going to be basically this blue candle would be our next inefficient or extreme demand. Had we seen the market come into that level, so if we'd have seen this come down and then provide us that break of structure up past the previous structural points, that would have given me a lot more confidence to then go and buy into where the demand had formed to take the market up towards the high. But the problem we have here is we obviously didn't get that solid reaction and we haven't really reacted from anywhere. All we've done is come into an imbalance, but there is still an imbalance beneath it too, right? So the problem we've got here is this isn't really coming from anywhere significant. Therefore, trying to buy into it, especially when we've had such significant bearish momentum, is going to be pretty risky because really the market could still come down to that area there. So just to explain, we could come down like this, then we could provide some bullish movements, and then we could actually go and finish the Asia high. So the problem that comes in with this trade, and something that I always try and get people to avoid, is if you are looking at a trade, you want to make sure that if you are right, you don't lose. That's the way that I like to look at trades. If I've taken a loss on a trade that I was basically correct on, then that's what I would consider a mistake trade. And the idea, the risk with this one is, as we've just explained, you could be right on this position because the market could do that, right? It could come down, hit demand, and then rally. But you could be wrong on actually making money. You could lose money even though you're right. I don't like trades where you can be right and lose money. That's why I always want to be buying from a point or selling from a point where I'm either wrong and the market goes completely against me. So, such as had we instead set this trade up from this demand with a stop loss there, I'd have been happier with that because we have two scenarios. The market breaks into efficient range. I'm wrong. I lose a trade. Or the market goes and takes out the high. I'm right. I win a trade, right? That's the way I like to look at things. With the position that's been taken here, although obviously, as I explained, I understand the concept behind it and the context behind it. You can be wrong. No, you can be right. So you're right on the idea, but you lose money because there's still opportunity for us to come down there, right?